A single overnight move, too fast to explain, too violent to ignore. Screens showed silver collapsing, but away from the screens, the metal itself was getting harder to find. Paper prices falling, physical availability tightening, and governments quietly changing their language. This is not a story about a bad trading day. It's about what happens when price stops telling the truth, when futures markets whip violently, while supply chains begin to whisper a very different warning. Because when volatility shows up before policy, and shortages appear without headlines, history says something important is forming beneath the surface. And the real question isn't what silver did last night. The real question is, who is preparing for what comes next? Welcome to Boring Currency Reports. If you've been around long enough to know that markets don't break loudly, but quietly, then you already understand why subscribing matters. Think of it like this. You don't wait for the evening news to tell you the weather ruined the crops. You listen to the people who've been watching the fields all season. So take a moment, subscribe to the channel, and join a conversation built for people who've seen cycles come and go. And tell us, from where in the world are you watching today? The story begins with a sudden move that felt out of place. Silver prices fell sharply in a narrow window of time, during hours when trading activity is usually thin. To casual observers, it looked like just another volatile day in a famously volatile market. But to experienced market participants, the speed and scale of the move raised deeper questions. This was not a slow sell-off driven by new economic data or a clear policy announcement. It was abrupt, disconnected, almost impatient. For professionals who study markets, price action is not just about direction. It is about context. When a market moves faster than explanations can form, it signals stress somewhere in the system. The issue is not whether silver went down. Markets go down all the time. The issue is how it went down, when it went down, and what failed to explain it. At the same time, silver was falling, other assets told a calmer story. Gold declined only modestly. Equity markets showed no panic. Bond markets remained orderly. There was no global shock that demanded a violent repricing of one specific metal. That imbalance alone made the move stand out. When one market breaks formation while others remain steady, it is often reacting to forces that are not yet visible to the public. In moments like this, explanations rush in to fill the silence. Commentators talk about profit-taking, technical resistance, or broad risk-off sentiment. These explanations sound reasonable, but they are often incomplete. They explain what could happen in theory, not why this happened now in practice. For decision makers, that difference matters. The people who operate at scale, fund managers, executives, institutional buyers, are trained to be skeptical of neat stories. They understand that markets are complex systems. When something moves violently without a clear trigger, it usually means that pressure had been building quietly beforehand. This is where the idea of the shock event becomes important. A shock event is not always a crash. Sometimes it is a sudden release of tension that exposes weaknesses in structure rather than fundamentals. In silver's case, the structure includes futures markets, leverage, margin rules, and liquidity conditions that can amplify small actions into large price swings. These mechanisms are invisible during calm periods, but they become dominant during stress. The timing of the move added to the concern. Overnight and early session trading often has less liquidity than peak hours. Fewer participants mean thinner order books. In such conditions, prices can move sharply with relatively little volume. This does not imply wrongdoing. It reflects how the system is built. But it also means that prices formed in these windows can be more fragile and less representative of real supply and demand. For business leaders and investors, this matters because many strategic decisions rely on price signals. Prices are supposed to summarize information. They are meant to tell producers when to invest, buyers when to secure supply, and planners when to adjust risk. When prices move violently without corresponding changes in the real world, those signals become distorted. What made this moment more troubling was what followed. As screens showed silver falling, reports from physical markets told a different story. Availability did not suddenly improve. Premiums did not collapse. In some regions, buyers still struggled to secure metal quickly at advertised prices. This disconnect suggested that the price shock was not driven by a sudden surplus of silver. Instead, it appeared to be driven by financial mechanics. This is a critical distinction. A price fall caused by oversupply sends one message. A price fall caused by market structure sends another. The first suggests relief. The second suggests instability. History shows that many major market events begin this way. The early signals are not headlines or official statements. They are anomalies. Prices that move too far, too fast, markets that stop behaving in sync, assets that suddenly feel unreliable as indicators of reality. In those moments, the greatest risk is not volatility itself. The greatest risk is misinterpretation. When decision makers accept simplified explanations, they may delay action or make commitments based on false comfort. They may assume that lower prices mean lower risk, when in fact the opposite may be true. This first shock in silver does not, by itself, prove a crisis. But it does demand attention. It asks a serious question of anyone responsible for capital, inventory, or long-term planning. What pressure was released here and where did it come from? The answer is not found in a single chart or headline. It requires looking beyond the initial move and examining the mechanisms beneath it. The process begins with understanding how futures markets can create sudden whiplash and why those moves can matter even when they do not reflect the physical world. That is where the story truly begins to unfold. They did not start with silver bars or mines. They started with screens, contracts, and rules written long before most participants ever touched metal. To understand why the price moved the way it did, one must step inside the futures market itself. Futures markets were not designed to reflect reality in real time. They were designed to manage risk. Over time, they became something else as well, a powerful engine that can move prices far faster than the physical world can respond. In a futures market, silver does not need to exist to be sold. Contracts are traded, not metal. These contracts represent promises, hedges, and positions layered on top of each other. During calm periods, this structure works efficiently. It allows producers to hedge, consumers to plan, and net investors to express views. But during stress, the same structure can magnify small shocks into violent moves. The key ingredient is leverage. Most futures positions are held with borrowed money. Traders put up a fraction of the contract's value as margin. This makes the market sensitive. A modest price move can trigger margin calls. Margin calls force traders to add capital or close positions. When positions are closed rapidly, selling accelerates. What begins as pressure turns into momentum. This is how whiplash forms. The process does not require panic or coordination. It requires rules acting exactly as designed. Risk systems protect firms by cutting exposure. Stop-loss orders activate automatically. Liquidity providers step back when uncertainty rises. Each action is rational on its own. Together, they can produce an outcome that looks extreme. For outside observers, the move appears emotional. Inside the system, it is mechanical. Timing plays a decisive role. During periods of low liquidity, fewer buyers are available to absorb selling. Prices fall until buyers reappear. That level may be far below where value exists in the physical market. Futures markets do not wait for balance. They search for it aggressively. This creates a dangerous illusion. Price appears to signal abundance even when nothing has changed in the supply chain. Executives and planners who rely on price alone may assume conditions have improved. In reality, only paper positions have adjusted. Exchanges monitor this behavior closely. Their primary concern is not price direction. It is market credibility. If participants believe prices are unreliable or easily distorted, participation drops, liquidity dries up, volatility increases further. To prevent this spiral, exchanges sometimes intervene by tightening rules, raising margins, or restricting certain activities. Such actions are rare and revealing. They signal that the market's internal dynamics are creating outcomes the venue itself considers unhealthy. This does not imply wrongdoing. It implies strain. For business leaders, the lesson is subtle but critical. Futures prices are excellent tools during stable periods. During stress, they can become poor guides to real conditions. A falling price may reflect forced selling rather than improving fundamentals. A sharp rebound may reflect relief rather than recovery. This distinction matters most for those exposed to physical supply. A manufacturer securing inputs, a dealer managing inventory, or an investor holding long-term positions must understand that futures markets react first and ask questions later. They respond to risk constraints, not warehouses. They clear leverage, not bottlenecks. This is why futures whiplash often precedes real-world consequences. When prices detach from reality, signals become confused. Producers delay investment because prices appear weak. Buyers hesitate, believing supply is loose. Meanwhile, the physical system continues operating under unchanged constraints. History offers many examples. Commodities have fallen sharply just before shortages worsened. Energy prices collapsed shortly before supply tightened. Agricultural prices dropped, even as harvest conditions deteriorated. In each case, paper markets spoke first, and reality followed later. Silver fits this pattern because of its structure. It is a small market relative to its importance. It is deeply financialized but physically constrained. It trades like a financial asset, but behaves like an industrial input. That combination makes it especially sensitive to futures-driven dislocations. The danger is not that futures markets exist. The danger is assuming they always tell the full story. For young entrepreneurs and aspiring business leaders, this is a broader lesson about systems. When systems are stressed, outputs become noisy, indicators lose clarity. Decisions based on surface-level signals become riskier. Serious decision-makers learn to ask different questions. Not, what did the price do, but why did it move that way? Not, is this cheap? But what behavior is driving this number? In silver's case, the future's whiplash suggests internal pressure, not external relief. It suggests that positions were unwound faster than the physical world could respond. It suggests that price discovery temporarily favored speed over accuracy. That does not resolve the story, it deepens it. Because when paper markets move violently while the physical world does not loosen, tension builds, and when that tension persists, it eventually seeks resolution elsewhere. The next step is to leave the screens behind and examine what is happening where contracts end and metal begins, inside the physical market itself. They did not notice it on trading screens first. They noticed it in delivery times, unanswered emails, and changing conversations with suppliers. While futures prices were falling and rebounding in rapid swings, the physical silver market moved differently. It did not rush. It did not collapse. In many places, it tightened. This is where the story shifts from finance to logistics and from speculation to reality. In the physical market, silver is not an idea. It is an object that must be mined, refined, fabricated, insured, shipped, and delivered. Each step takes time. Each step has capacity limits. When those limits are reached, price alone cannot fix the problem quickly. This is why physical shortages rarely announce themselves with empty minds. They appear as friction, delays, rising premiums, limited formats, sellers who hesitate before quoting prices, buyers who are told to wait. The most misunderstood concept in physical markets is availability. Availability does not mean silver no longer exists. It means silver cannot be secured in the right form, at the right location, within the required time frame, at a price someone is willing to commit to. That distinction matters deeply for businesses. When futures prices drop sharply, one might expect physical supply to loosen. But in stressed systems, the opposite can happen. Sellers become cautious. Replacement risk rises. If a dealer sells inventory today at a falling screen price but cannot restock tomorrow at the same cost or speed, that sale becomes a loss. Rational actors protect themselves. This behavior is often mistaken for greed. In reality, it is risk management. As volatility increases, physical sellers widen premiums or pause sales altogether. Not because demand has vanished, but because uncertainty has increased. Premiums are not simply markups, they are signals. They reflect confidence, or the lack of it, in the supply pipeline. This creates a critical divergence. On screens, silver appears cheaper. In the real world, it becomes harder to obtain. For executives and entrepreneurs, this is a warning sign. It suggests that price is no longer performing its coordinating function. Supply chains do not respond to price in isolation, they respond to stability. Refineries operate on schedules set months in advance. Mints require steady input flows. Shipping depends on insurance, compliance, and timing. When volatility spikes, every link becomes more cautious. Small disruptions compound into visible strain at the retail and industrial level. This is especially relevant for silver because much of its supply is a byproduct of other mining operations. Production does not increase simply because price rises. Likewise, production does not flood the market when price falls. Supply is slow, rigid, and dependent on decisions made long before current market conditions. In such an environment, price declines driven by financial markets do not relieve physical tightness. They can worsen it. Producers delay investment. Refiners hesitate to expand capacity. Sellers hold back inventory. The pipeline narrows. For those watching carefully, the signals are subtle but consistent. Delivery timelines extend. Product variety shrinks. Smaller, more accessible formats disappear first. What remains are larger units that fewer buyers can absorb. This is a classic stress pattern across commodities. The physical market does not move in headlines. It moves in quiet adjustments. These adjustments often go unnoticed until they reach a tipping point. For business leaders, this creates a strategic dilemma. Lower prices invite buying. Tighter availability discourages it. Acting on one signal while ignoring the other can lead to costly misjudgments. The most dangerous assumption is that physical markets will eventually align with paper prices. Sometimes they do, but sometimes paper prices are the ones that must adjust upward to reflect reality. The direction of resolution is never guaranteed. History shows that when physical constraints persist, they eventually assert themselves. The delay between financial repricing and supply response can create periods of confusion. During these periods, firms that rely on just-in-time sourcing face heightened risk. Inventory becomes a strategic asset rather than a cost. This is where silver's dual nature becomes important. It is not only a financial instrument, it is a working material. It flows into electronics, energy systems, medical tools, and infrastructure. These uses do not pause because prices are volatile. Demand at this level is often insensitive to short-term price movements. When industrial demand intersects with financial instability, physical markets feel the pressure first. Premiums rise quietly, availability tightens unevenly, and price, the public signal, lags behind. The lesson for decision makers is clear. When price and availability diverge, availability deserves more weight. Businesses fail not because assets are expensive, but because inputs are unavailable when needed. The strain visible in the physical silver market suggests that the recent price swings did not resolve underlying tension, they may have intensified it. And when physical markets begin to speak this way, attention naturally turns to another powerful actor, policy. Because when availability becomes uncertain at scale, governments eventually take notice. That is where the story moves next. They were not watching price charts. They were watching production schedules. Industrial buyers do not react to silver the way traders do. They do not debate momentum or technical levels. They calculate inputs, reliability, and continuity. For them, silver is not an asset. It is a function. And that difference quietly reshapes the entire market. Silver sits inside systems that modern economies cannot easily pause. Power generation, electronics, medical equipment, data infrastructure, and advanced manufacturing all rely on it. In many of these applications, silver is used because it performs better than alternatives. Substitutes exist in theory, but not always in practice, and rarely at scale without redesign. This makes a portion of silver demand structurally inelastic. When price rises or falls, industrial consumption does not respond immediately. Factories do not stop mid-cycle. Grid projects do not cancel wiring plans. Medical suppliers do not delay production because futures markets moved overnight. This creates a persistent draw on physical supply that financial markets often underestimate. Unlike investment demand, industrial demand is planned months or years ahead. Contracts are signed, budgets are approved, components are specified. Once embedded, silver becomes difficult to remove. This means that even during periods of price weakness, metal continues to leave the market steadily. At the same time, silver supply remains constrained by its production structure. Most silver is mined as a byproduct of copper, lead, zinc, and gold operations. This means silver output responds primarily to conditions in other markets. A surge in silver demand does not quickly translate into increased silver supply. This mismatch creates tension. Demand moves with technology and infrastructure. Supply moves with unrelated mining economics. For business leaders, this is a familiar problem. It mirrors what happens when critical inputs are sourced indirectly. Control is limited. Flexibility is low. Risk accumulates quietly until it becomes visible. As global electrification expands, silver's role grows rather than shrinks. Solar installations require it. High-efficiency electronics require it. Data centers require reliable conductive materials. Even small increases in unit usage, multiplied across massive projects, translate into meaningful demand. This demand does not seek headlines. It does not announce itself in daily price action. It appears as steady offtake that tightens availability over time. Financial markets often miss this because industrial demand lacks drama. It does not spike suddenly. It does not collapse suddenly. It simply persists. This persistence becomes dangerous when combined with volatility. When futures prices fall sharply, investors may reduce exposure. But industrial buyers often see such drops as opportunities to secure supply. This can absorb available metal quietly, especially in stressed physical markets. The result is a market pulled in two directions. Paper markets react to risk constraints. Physical markets respond to necessity. Industrial demand anchors one side of the equation, even as financial sentiment swings wildly. For aspiring entrepreneurs and executives, this highlights a broader strategic lesson. Markets are shaped not only by visible actors, but by silent ones. The most important pressures are often the least discussed. When analysts focus solely on investor behavior, they miss the structural pull of real-world use. When businesses rely only on price signals, they risk being surprised by shortages. Silver's industrial role also introduces policy sensitivity. Materials embedded in critical infrastructure eventually attract attention from governments, not because of investment returns, but because of resilience and security. This is how ordinary inputs become strategic materials. Once a material is recognized as essential to national or economic stability, its treatment changes. Governments begin to monitor supply chains. They encourage domestic sourcing. They explore reserves. They coordinate with allies. These actions are rarely announced loudly. They emerge gradually in policy language. The combination of persistent industrial demand and constrained supply creates the conditions for such attention. It does not guarantee it, but it makes it logical. From a strategic perspective, this shifts how risk should be assessed. Volatility in price becomes secondary to continuity of supply. The question changes from how cheap is this to how reliable is this. Industries that ignore this shift often learn too late. When inputs are abundant, efficiency dominates decision-making. When inputs become uncertain, resilience becomes paramount. Silver's quiet industrial pull suggests that recent market moves did not occur in isolation. They occurred against a backdrop of steady consumption and limited flexibility. This makes sudden price declines less reassuring and sudden price spikes more disruptive. For decision makers, the implication is not to panic, but to recalibrate, to recognize that some forces operate beneath the surface, unaffected by daily noise. As industrial demand continues to draw metal out of circulation, and as physical markets show signs of strain, another layer enters the picture. Policy. Because when silent forces reshape markets, governments eventually respond not to prices, but to risks. That response, hinted at rather than declared, forms the next critical chapter of the story. They did not announce a decision. They adjusted their language. Policy rarely moves in straight lines. Before laws are written or programs are launched, there is a quieter phase where words begin to shift. Phrases appear more often. Concepts are grouped differently. Priorities are implied rather than stated. For experienced observers, this phase matters more than formal declarations. In recent discussions across policy circles, one phrase has gained weight: critical minerals. On the surface, it sounds technical and broad. That is intentional. Governments prefer flexible categories, especially when supply chains are under review. Broad language allows room to act without committing publicly to specifics. What matters is not which materials are named, but why the category exists. Critical minerals frameworks are not about investment returns. They are about continuity. They are designed to answer a single question. What materials would cause serious disruption if they became unavailable at the wrong time? Once that question is asked, price becomes secondary. This is where policy logic diverges from market logic. Markets respond to incentives, governments respond to vulnerability. When policymakers begin discussing coordination, price stabilization, or strategic reserves, it is usually because they believe the existing system is too fragile to rely on during stress. These conversations often follow periods of volatility, not calm. They are reactions, not forecasts. One of the most telling concepts that appears in these discussions is stockpiling. A stockpile is not a trade. It is a statement. It says that availability matters more than cost, and timing matters more than efficiency. For businesses, this distinction is crucial. A government buyer does not behave like a private buyer. It does not wait for dips. It does not exit positions quickly. It acquires quietly and holds patiently. Even modest stockpiling can alter market balance because it removes material from circulation without regard to price signals. Importantly, policy does not need to name silver explicitly for silver to be affected. Many materials are pulled into strategic frameworks indirectly because they sit inside larger systems. Silver's role in electrification, energy, and technology places it adjacent to materials already under scrutiny. This creates uncertainty, not certainty. But uncertainty itself has consequences. When suppliers believe policy demand might emerge, behavior changes. Long-term contracts become more valuable. Inventory is treated differently. Exports are reconsidered. Even the possibility of future stockpiling can tighten markets in the present. At the same time, policymakers are cautious. They avoid alarming language. They avoid signaling urgency prematurely. Instead, they speak of coordination, resilience, and frameworks. These words sound neutral, but they carry weight. For entrepreneurs and executives, this is a familiar pattern. It mirrors how companies prepare for risk internally. First comes assessment, then alignment, then contingency planning. Action follows only when necessary. The danger lies in waiting for confirmation. By the time policy moves become explicit, markets have often adjusted. The window for preparation closes quickly because government actions tend to compress timelines. When a strategic buyer enters a market, flexibility disappears. This does not mean that a silver stockpile is guaranteed. It means that silver now sits closer to conversations where availability is treated as a security issue rather than a pricing issue. For serious decision makers, this changes how information should be interpreted. Policy language is not noise. It is an early warning system. It reflects concerns that are not yet visible in data releases or price charts. The mistake many make is demanding certainty before adjusting strategy. But strategy does not require certainty. It requires probability assessment. The combination of futures volatility, physical strain, persistent industrial demand, and shifting policy language forms a pattern. Each element alone is explainable. Together, they suggest a system under pressure. Governments do not intervene because markets are cheap. They intervene because markets are unreliable under stress. When reliability is questioned, policy steps in to reduce exposure. This is why the policy angle matters, even without confirmation. It introduces a non-market actor with different incentives, timelines, and tolerances. It adds a layer of demand that does not respond to price the way businesses and investors expect. For the business community, the lesson is not to speculate on policy outcomes, but to recognize policy direction. Availability is moving up the priority list. Resilience is being valued over efficiency. And when that shift occurs, markets that appear calm on the surface can change quickly underneath. This brings the story to its final and most practical question. What does all of this mean for those responsible for capital, operations, and long-term decisions? That is where the analysis must ultimately land. They were not being asked to predict prices. They were being asked to interpret risk. For business leaders, entrepreneurs, and capital allocators, the silver story is not about whether the price goes up or down next week. It is about how systems behave under strain and how early signals often appear in places most people dismiss as noise. What has unfolded across futures markets, physical supply chains, industrial demand, and policy language forms a pattern that deserves careful attention, not because it guarantees a crisis, but because it challenges assumptions that many decision makers rely on. The first assumption is that price equals reality. In stable conditions, price is a useful shortcut. It aggregates information and coordinates behavior. But in stressed systems, price can become distorted by mechanics, incentives, and timing. Futures markets, in particular, prioritize speed and risk reduction over accuracy. They react to leverage, margin rules, and liquidity, not to warehouses or delivery schedules. When price becomes volatile without corresponding improvement in availability, it loses some of its signaling power. Executives who rely solely on price may delay action, believing conditions have eased, while operational risk quietly increases. The second assumption is that supply responds quickly. Silver exposes the weakness in this belief. Its supply is slow, indirect, and constrained. Its demand, especially from industry, is steady and often inflexible. This creates a system where shocks are absorbed unevenly. Financial markets adjust first. Physical markets adjust later. Policy reacts last. Those who wait for confirmation at every stage often find themselves reacting rather than preparing. This is where strategic thinking matters. The role of leadership is not to forecast exact outcomes. It is to identify asymmetry. In this case, the asymmetry lies between downside price risk and upside availability risk. A lower price does not guarantee easier access. A higher price, driven by policy or supply stress, can appear suddenly and persist. From a business perspective, this changes priorities. Inventory management becomes more important than price optimization. Supplier relationships become strategic assets. Optionality, having multiple sourcing paths, gains value. Young entrepreneurs often focus on efficiency. They are taught to minimize inventory, reduce costs, and rely on smooth markets. These principles work well until they do not. Periods of stress reveal their limits. More experienced leaders recognize that resilience has a cost, but fragility has a greater one. Another key implication is the role of non-market actors. Governments enter markets when they believe private systems may fail under pressure. They do not need certainty to act. They need enough risk to justify preparation. When policy language shifts toward coordination, price stabilization, or stockpiling, it introduces a new variable that traditional market models struggle to capture. This variable does not chase returns. It seeks security. For investors and businesses alike, this means that historical price behavior may become a less reliable guide. Markets influenced by policy can move in ways that feel illogical to those expecting purely economic behavior. The silver case illustrates a broader lesson applicable across sectors. Early warnings rarely arrive as clear signals. They arrive as inconsistencies, prices that move without news, markets that diverge from each other, language that changes subtly before actions follow. Those who train themselves to notice these inconsistencies gain time. Time to reassess exposure, time to adjust assumptions, time to ask better questions. The wrong response is panic. The right response is calibration. Decision makers should not ask, is this bullish or bearish? They should ask, what risk is being repriced and where? They should observe whether physical constraints persist, whether industrial demand remains steady, whether policy language continues to evolve, and whether market interventions become more frequent. These observations do not demand immediate action. They demand attention. In many historical cases, the greatest losses did not come from being wrong about direction. They came from being wrong about structure. Leaders assumed systems would behave tomorrow as they did yesterday. They underestimated how quickly rules change when stress accumulates. Silver's recent behavior suggests that structure is under review. Not officially, not conclusively, but meaningfully. For those responsible for capital, operations, or long-term strategy, the takeaway is simple but uncomfortable. Periods like this reward patience, preparation, and humility. They punish overconfidence and simplistic narratives. The purpose of this analysis is not to argue that silver is scarce tomorrow or that governments will act next week. It is to highlight that signals are aligning in a way that deserves respect. Markets do not send warnings in bold letters. They whisper through friction, volatility, and language. Those who listen early rarely regret it.